What separates hedge funds from most retail traders is not necessarily better predictions, it's risk management. Professional traders understand that survival comes first. If you can consistently protect capital during volatile periods, opportunities will always come later. In today's video, we're going to break down the risk management trading secrets used by hedge funds and institutional trading desks to navigate unstable markets, control drawdowns, and stay in the game long term. And some of these concepts may completely change how you think about trading. Hey, it's Frank Nagy. Welcome to my channel where we help financial entrepreneurs grow their business in the financial markets. If you're new here, subscribe to my channel and hit that like button. Most retail traders focus almost entirely on profit. Hedge funds focus first on exposure. Before entering the trade, institutional traders ask questions like, how much portfolio risk does this add? What happens if volatility expands suddenly? How correlated is the position to everything else we own? And what is the liquidity risk? What is the worst case scenario? The average trader may look at a setup and think, this could make me 20%. A hedge fund may look at the same setup and ask, how much can this realistically lose under stress conditions? That mindset difference is massive. Institutions understand that protecting capital creates longevity, and longevity creates compounding. One of the biggest hedge fund secrets is that position sizing matters more than entries. You can have an excellent strategy and still fail because your sizing is too aggressive. Professional funds often risk a very small percentage of the total capital on any individual trade. Even high probability trades fail. Many institutional traders think in terms of volatility adjusted sizing. That means larger volatility equals smaller position sizes. Lower volatility environments mean larger exposure, and this prevents one trade from causing catastrophic damage. Retail traders often do the opposite. They increase size during emotional market conditions, and that usually leads to oversized losses during volatility spikes. Hedge funds survive because they stay disciplined with exposure. Hiring an experienced hedge fund consultant like Frank Nagy Financial Services will greatly reduce the burden of setting up your hedge fund or offshore broker-dealer. A good consultant will make the appropriate introductions with hedge fund administrators, brokers, auditors, prime brokers, and bankers that will help your hedge fund broker-dealer grow. Another major institutional secret is this: many hedge funds are almost always hedged. Retail traders often think trading means choosing only bullish or bearish positions. Institutions think more in terms of relative exposure. For example, a hedge fund may be long technology stocks while short an index future, or long high quality companies while short weaker sectors. The goal is not always maximizing gains. Sometimes the goal is reducing portfolio volatility while maintaining opportunity. Options are also heavily used in protection. Professional fund managers may buy puts, structure spreads, or reduce directional exposure because of a major economic event. Hedging reduces emotional decisions making because risk is already partially controlled before the market even moves. One thing institutions understand very well is that volatility changes market behavior. During low volatility environments, trends often behave differently. During high volatility periods, correlations increase and markets can move violently. Hedge funds consistently monitor volatility indicators, not just the VIX, but realized volatility, implied volatility, sector volatility, and cross-asset volatility. And when volatility expands aggressively, professional traders often reduce leverage. They may decrease position size, tighten risk limits, or move partially into cash. This is something retail traders rarely do. Instead, many traders increase risk during chaos because they see longer opportunities. Institutionals know that volatility expansion can destroy accounts faster than almost any case. Here's another institutional principle that separates professionals from amateurs. Hedge funds are obsessed with drawdown. A 50% loss requires a 100% gain just to break even. And this is why many professional firms have strict portfolio level stop mechanisms. If losses hit a certain threshold, exposure gets reduced, trading slows down, risk managers intervene, and some strategies may even shut down temporarily. Institutions understand that avoiding catastrophic losses is more important than chasing aggressive gains. Consistency matters more than excitement. Another overlooked hedge fund secret is liquidity management. During market stress, liquidity can disappear quickly. That means spreads widen and exiting positions becomes much harder. Institutional traders care deeply about average daily volume, market depth, bid-ask spreads, and event risk liquidity. And this is why many funds avoid oversized positions in an illiquid product. Retail traders often ignore liquidity completely until volatility appears. But in stressed markets, liquidity risk becomes real risk. Professional traders prepare for this before entering a trade. The biggest hedge fund trading secret is not some hidden indicator, it is discipline. Institutions follow process-driven systems. They use risk committees, exposure limits, daily stress testing, portfolio reviews, and structured decision making. Professional trading is often less emotional and more statistical. The goal is not being right every day. The goal is managing risk well enough to survive long enough for probabilities to play out. That is the real edge. Hey, if you'd like to learn more about Frank Nagy Financial Services and how we can help you set up your hedge fund or offshore broker dealer, click on the links below in the description box.